Welcome to Barchart's series of educational webinars designed to enlighten you about a variety of investment ideas and concepts, to inform you of the features and tools Barchart provides related to these concepts, and offer you some trader's insight to help you make a more informed investment decision. Today's session, achieving long-term success with penny stocks. Now, back on October 9th, we did a webinar session titled Beyond the Gamble, How to Trade Penny Stocks for Consistent Success. And you can find that on our archive webinar learn page. And in that video, we discussed the steps to identify candidates, the catalysts and drivers, risks associated, and chart patterns that are typically found with penny stocks, with the promise that today's session would focus on technical analysis, risk management, and strategies one could employ, with the understanding that the goals and objectives of trading penny stocks is not to get rich quick, but a more longer-term horizon where we find multiple candidates, we recoup our initial risk, lock in profits, and hopefully one of those candidates turns into a lottery ticket. Hello, everyone. My name is John Rowland, Barchart Senior Market Strategist, and I'm excited about today's session because we're going to look at a variety of technical analysis, and we're going to apply risk management and executing some simple risk to reward strategies that are suitable for really all assets and styles of traders. Now, before we get to that, please welcome our moderator and Barchart's project director, Gene Baker. Hello, Gene.
Happy Wednesday, John.
Happy hump day. Happy hump day.
Yeah.
I know in the pre-session you said you have a little frog in your throat, so I'm not going to burden you right now, but thanks for being here.
Not gonna make me croak, right?
Exactly. Hopefully you won't croak.
No.
All right, excellent. So let's get started, Gene. Just a reminder that today's session is for educational purposes only, and decisions to buy, sell, or hold securities, commodities, or any other investment involves risk and best made on the advice of a qualified financial professional. Under no circumstances shall we be liable for any loss or damages you or anyone else incurs as a result of trading or investment activity that you or anyone else engages in based on the information or material you receive through barchart.com and our services. Okay, so let's start with some quick review from our last session and look at some key concepts before we move on to technical analysis and risk management. So what is a penny stock? Well, they're typically, any stock below $5 that doesn't really have institutional coverage, but typically they are over-the-counter stocks that trade for less than $1. Now, penny stocks volatility and price percentage change movements create opportunities and also risk. So this presents a challenge for us, and why it's important for us to have risk management. Now, our goal is to stay in the game and be disciplined. And we're going to discover that we won't pick winning lotto numbers, so to speak, but the market will pick them for us. And that only time will tell if we have one of those big winners. So let's just kind of review a couple of things. So volatility and liquidity. So again, these two have a profound impact on penny stocks, and mostly because of the limited institutional ownership and small capitalization. And so when we measure volatility, there's a lot of different ways we can measure volatility, but how we're going to gauge volatility. And this is going to help us with our risk management, our discipline. So the main tool we're going to work with or talk about today is going to be the average true range, or the ATR. Now, if you're not familiar with the ATR, I would suggest to you come back into our archive webinars, go into the search here and type in the word knife and look for that. And there is a webinar that I did that really, I think, is gives you a greater understanding of the versatility of the average true range, or the ATR. So I would recommend that you look at that. Okay. So liquidity considerations, the importance of finding liquid candidates. Now remember that we want to put volume in a notional perspective. In other words, 100,000 average volume might sound like a lot of volume, but if we're only talking about a penny stock, literally a 1 cent stock, well, that equals $1,000. That's not a lot in comparison to the total volume. But volume spikes and average volume increases will help us confirm the price action that we witness. And we're going to definitely look at that as a part of our process. Technical analysis, our challenges and our adaptations. So we talked about that, how traditional technical analysis often fails us because of several reasons. The main reason is the extreme volatility, that markets can be overbought or oversold for longer periods of time, or that these larger percentages can blow out some of these more traditional technical analysis. And the last time we talked about adjusting look-back periods to smaller valuations, but with that understanding that lower periods create quicker signals, but also increase a lot of false ones. So we're going to look at some other non-traditional tools like the VWAP, which is volume weighted average price, a weighted alpha, and if a stock has options, we could look at options flow. But for today, we're going to concentrate on VWAP, weighted alpha, and ATR, and we're going to leave options for our other options related sessions. Okay. And then chart patterns and candlestick patterns. Now, here we're going to rely on price pattern recognition, but also we can use these price pattern recognitions to add to our risk discipline. This will allow us to tell us that we can take a trade or that maybe we might need to wait. So in the session before, we talked about 4 categories of pattern recognitions that are kind of unique to penny stocks. And I categorize them in these 4: rocket ship rallies, moonshots, random wanderers, death spirals and heart patients, and stairmasters. Now, in that previous session, we discussed and showed multiple examples of each of these. Today, we're going to focus just on 2, the rocket ship rallies and our stairmasters. Now, what we're going to discover is that many of our stairmaster candidates, which are the highly desirable ones we want to try to find, these are the ones that the stock is trending positively. In other words, making higher highs and higher lows. But many of these stairmaster candidates will get their launch from a rocket ship rally. I know, I just couldn't help myself on that pun, but seriously, we will walk through this process. And then, traditional patterns, right? The flags, pennants, triangles, not only will help us identify potential candidates, maybe breakout candidates, but also can play a part in our risk management. Reversal patterns will warn us to activate some kind of risk management strategy, like either profit taking or stop adjustment. And there could be some unique candles or combinations of candle patterns that will aid in our risk management as well. Now, one in particular we're going to look at is called a Marabuzo. I think that's how you pronounce it. My Japanese is not that great. But Marabuzos will be rocket ship rallies and then eventually, hopefully, turn into stairmasters. Now, so let's start here. Let's jump off from this point. So Where do I want to go? Okay, where we go. So again, last session, we created this watch list that had a lot of different chart patterns. And again, these are not endorsements of any penny stocks, although there are a couple in here that I currently own positions on. But one of the difficulties with rocket ship rallies is that they fall quickly back to earth. However, many times that ensuing original rally, that launching pad, so to speak, can act as a level of support. So here's a great example of that. So here we have a spike in volume. And notice here that what we're seeing here is a lot going on just in this one little candle here. First of all, we broke out of this little bit of a range. That's a great sign. And volume confirmed that price action. And then eventually we get another big candle, large body candle that broke out of another range. Now that was surrounded by two high volume events. So that again would be a positive sign. So what can we do, or how can we identify these rocket ship rallies to take advantage of them as they take off? So one of the tools that we can look at our non-traditional technical analysis under indicators is anchored volume weighted average price. And again, if you're not familiar with this one, we do have a webinar where we go in a lot more detail. But I'll just give you the Reader's Digest version. It's basically is going to tell you is the average price of traders or position traders during a particular price movement, right? And again, we kind of want to just focus on a shorter period of time. In this case, the rocket ship rally. So what I'm going to do is I'm going to come over here and I'm going to put my cursor right on the beginning of that takeoff, that launch pad, and then I'm going to apply. And so you can see the purple line here represents the VWAP. So as price is moving, or as the market is moving in this direction, it can become a level of support, and which also could be a potential level of entry. Now, when the VWAP goes flat or actually turns negative, that is starting to tell us that those that are in the market are actually starting to lose money, or actually their average is below current price. So it can be used as a level of support, but when price is below, then it's a level of risk. It tells us that there's more likely that price is going to continue to go down as those who got in get out. So let's look at a couple of rocket ship rallies. So here's another good example. Again, we could run with it as the market is moving up, but you can see that our VWAP kind of turned flat, but we're kind of bouncing back and forth on both sides of this. This, tells me that it's probably more risk to the downside than there is potential to the upside. Now, it doesn't mean that this might not be a good candidate eventually, but I think I need this stock to prove itself, and that would be that I want to see price get above, let's say, this red candle or this red candle before I get excited about it. Here's another example, right? Big spike in volume, right? Big rocket ship rally, but then when we get below our VWAP, right? Maybe initially an intraday support, but again, more of a sign that we're going to fall back, to earth or close to our launching pad. So let's do this. Let me come in here and I'm going to take my VWAP off for a second. So here is a stock. We're going to look at it a couple times here, and let me go back in here. Let me start over. There we go. So one of those technical analysis or candlestick patterns we're going to look at is called that Mariposa. Now, Mariposa is basically just a large body candle, which usually has no wick or very small wicks or shadows, as some folks would call them. So the idea behind this is our rocket ship rally, and what we can use this as a potential opportunity or an entry into the market. So the theory behind that is if price, when it returns inside the body, can maintain above 50% of the body, that is a positive sign. Now, you could use the 50% level as an entry point or a confirmation, right? In other words, let's see the market hold and then wait for price to get back above the Mariposa. And then we can also use the Mariposa as a moment of risk. In other words, where would I be wrong? Where would that rocket ship Raleigh fall back to the earth? Well, that would be below the Mariposa. So let's go over here to the left. This is our toolbar, and I'm going to click on here, and here we can see 50% line. And this is a really easy tool to use. You can just come over here. If you know the values, you can type in it, but this is really much easier to do it this way. Just click on the top of the Mariposa and click on the bottom and then apply it. And so you can see that black lines is tops and bottoms and the purple line is at 50%. And so you can see how it held that up. That is a very positive sign. Again, you could have put an entry down here. Now, there's not always guarantee that we're going to get that 50% entry. But in this case, certainly on this large body candle, that broke out above our Mariposa and took out these two last red candles, that would probably be a good entry level. Our risk would be the bottom of the Mariposa. All right. So let's look at another example. Again, here is that mirror. Now this one has a longer shadow, so this is kind of an adaptation, but it is a large body candle that has no shadow or wick on the bottom. And again, you can see what we held that 50% line. Now, again, some of you might say, oh, well, the wick went below here, or maybe we may candle my probe below here. Again, I'm not going to throw away a candidate because, we have a little bit of a piercing below the 50% line. But if my wick goes all the way down or it goes deep into my Mariposa, then yes, I'm going to make this stock prove to me that it's a better candidate. And again, I would probably wait for more of a confirmational entry. In other words, I'm waiting for price action to get above the candle that, let's say, pierced deeply into my Mariposa. All right. So let's look at one more example. Again, here's that 50% line. Again, that piercing that was down in here. So now I'm got a little bit less confident, but now I'm waiting for, that confirmation once price gets above, and then I can go with it. Now, notice though, on this particular one, we did get a return, but we can see in the short run here over the last couple of days, how the 50% did act as a level of support. And again, if we go back to our anchored VWAP and I add that based on where the rocket ship took off, then you would notice that even though it's horizontal now, it is acting as a level of support. So here we have two complementary technical analysis, non-traditional technical analysis, that are telling us in this particular stock that this might be a low risk entry, because I could enter here at $1.38 and I could risk the low of this candle, which is around $1.08, 30 cents, right? Not a lot of risk depending on how I do my risk assessments. Okay. So before we move on to risk assessments, or we move on to, let's say, our Stairmasters, let me give you, just gonna kind of tease you a little bit. So these are the type of stocks that we're kind of look for, right? Those stocks that are attributing positive price movement or uptrend. Again, Stairmasters have a lot of impulses and pullbacks, and they kind of look like a stair. All right. Now, before we get to that, let's go back into our slides. And let's talk about risk management. And again, we're just going to talk about some more definitions and terms here. So first one is risk reward ratio, or this potential profit versus potential loss. Now, sometimes you might hear people say it's risk to reward or reward to risk, or it's a ratio. Again, it's just semantics. The importance of the understanding is a unit of risk versus a multiple of units of reward. That's what we want to look for, right? We want to look for trades where we're risking a small amount and rewarding ourselves a larger amount. Unit of risk. No, unit of risk is a percentage of the available trading capital. Now, seasoned traders keep their unit of risk to 1 to 2% of their trading capital account, how much money they have put aside for risk trading, capital trading. Now, for some folks, especially our penny stock pickers, this might be a difficult concept because they might find themselves risking a greater percentage, let's say 20%, 50%, or dare I even say it, all in on just one stock. But the reality of successful traders is this discipline of a 2%. Now, here's the thought behind the 2% discipline. In theory, you have 50 chances, right? Versus just a handful. And remember, this is a long game, right? We're not in it for the quick, right? So we want to minimize our risks. Stop loss. So stop loss is the price point where we believe that your analysis is wrong. It's pretty easy on concept. And this could be based on a tolerance of market volatility and our unit of risk, which brings us to ATR. And ATR is a measurement of volatility, but because it is linked to volatility and probability, it makes for an excellent stop loss tool. It makes for an excellent calculating of position sizing. So quickly, I want to kind of show you where you can find ATR in our charts or on our, before we move on. So if I go to any data page or on, in the flip charts, over here on the side, it says more data. I'm going to click this plus sign, and this is going to pull up this box. And in the middle here, it says technicals. And you can see we have a 20-day average true range. But remember that traditional technical analysis might give us some false signals or might not be as effective. So what we might want to do is there's problematics of longer periods of time. So we might want to look for a smaller period of time, right? Or a smaller look back. So if I clicked on the all technicals, that will take me to this page. And here you can see that we have an average true range. We give you different measurements. And a shorter term 9-day or 14-day, typically with penny stocks, will be greater than, let's say, the 20-day. Now, if you're looking for this page, on any equity page, any of the page of an individual equity stock, ETF, whatever, you will find it in this column under the technical analysis. Again, it's the technical analysis of this particular stock. That is the all technicals that is found through the more data page. Okay, so let's go back to our position sizing. All right, so this is where it starts to get fun. So position sizing fulfills two maxims for us. First of all, it helps us organize, or excuse me, optimize our unit of risk, and while keeping us in check so we don't over allocate, commit too much capital to one particular stock. Now, once we establish a unit of risk, we take our total trade equity times that percentage that we picked, right? That 2% rule. Now, for instance, let's just say I have a $10,000 account and I'm using that 2% rule. That means my risk per trade is $200. So now what I want to do is I'm going to determine my stop loss price and my risk per share. Now that will be our entry price minus our ATR. Now I say minus because I'm just assuming that we're going to be looking at long positions. Again, if I'm doing a short position, then it would be plus. But depending on the style of the trader, for instance, a day trader would use a fraction of the ATR, a quarter, a third, a half, something like that. But positions traders, which I'm assuming that most of you are going to do, we're going to use a multiple of ATR. Now, my preference is 2 times the 9-day moving average, or excuse me, the ATR. In other words, if price moves 2 times the ATR directionally, now ATR is not a directional measurement, it's just the probability of price range. But if it moves directionally against me, then I'm probably wrong. Calculating position size. So this is done by dividing our unit of risk by our risk per share. Now, our risk per share in this example is going to be 2 times our ATR. Now, once I establish my position sizing, I need to check my position value to ensure that it aligns with my allocation maximum. Now, typically, that is capped at 5%, but I would never go personally above 10%. Again, the more units of capital allocation, the more chance of finding that big winner and limiting my chance of blowing up my account. So I'm going to take that position that I've derived size and I'm going to time it by my entry price. And if that value is over my allocation, then I'm going to adjust my position by simply dividing the maximum allocation by the entry prices. Now, some of you are probably quick enough to figure this out. You say, John, can I skip the previous step? And yes, you can. You could just go to your allocated amount and divide it by your entry price. But I want to show you 2 ways to skin a cat because there might be moments and times where your position size will not be your total allocation and you give you some leeway. Now, maximum loss is basically our position size times our risk per share. Now, we're assuming here that our closing our position at our chosen exit point. Now, here's where liquidity is important to us. Low liquidity markets increase the chances of slippage. In other words, not getting the price that we want to get out. We might end up losing a little bit more. That increases our dollar risk. Okay. All right, so let's put this all together now. So I have a limited amount of capital to play penny stocks, but if I use a proper discipline and a plan, I can be quite effective. So let's walk through this. So let's assume I have an account that only has $2,000 in it, or that's all I want to risk trading penny stocks. So my unit of risk, $2,000 is my capital times my percentage of capital, in this case, our 2% rule. So my unit of risk would be $40. Now I'm going to determine my stop loss price and my risk per share. And that's going to be my entry minus my, in this case, multiple of my ATR. Now we're going to look at CYB in a second, CYBL in a second. And the entry price that we use that I time of press here when I've created this slide that I'm going to use is 0.012 minus 2 times our ATR. The ATR at that moment in time was 0.0024, so 2 times that would be 0.0048, when that would equal a stop loss price of 0.0072. I'm going to calculate my position size, my unit of risk, $40, divided by my risk per share, 0.0048. And that will equal a share size of 8,333. Now, typically what I do is when you get this kind of like these off numbers, I always round down to the nearest hundred. You don't need to do that. I just find that as a good practice. So now we have a share value of, we have a share of 8,300 shares, but we got to see how much that is in a position value. So we're going to times that by our entry price. So 0.012 times 8,300 equals $99.60. That's the cost of the 8,300 shares. Now, what is $99.60 as it relates back to our capital account? Well, it's approximately 5% inside of that restriction or that maximum capital allocation that we said most successful traders use. But let's assume that I'm going to do it the other way. I'm going to say, okay, I know I'm going to allocate $100 or 5%, but let's say assume our entry price is higher, right? In this case, 0.014. Then my position size would be 7142 or 7,100 shares. Okay. All right, so again, here's my watch list. Let's go to flip charts, and there is CYBL. All right, there is our Mariposa. I'm going to come in and symbol under settings. I'm going to cancel the 50% line for the time being. And, again, when I was doing this, the market was up here and I was thinking, well, I had this Mariposa and then I had another Mariposa here. So we had like this area. This to me, I felt was an area of support. So I was thinking that an entry level around, this 0120 level would be a good entry level. Again, in this case, the market is below here right now. It doesn't mean that's the end of the world. I know where I'm going to set this trade up based on, my values and my risk tolerances. Okay, so how do I do that? Or how do I measure that? So again, I'm going to come over to the tools here and down here, where we found the 50% line, we also find something called the risk reward. And what I can do is I can type in those values. So the entry price was 0.012. And my stop loss, again, is my entry minus my ATR multiple. In this case, I'm going to use 2 times our 24. In case you don't believe me, over here, more data, technical analysis. And there you can see that, well, it's jumped today. It was 2.4 at press, 2.4 at press time. It's jumped a little bit today. So 2 times 24 is 48. So 48 from 1.2 would give us 0.072. That would be our stop. Now our target price, we can do this a couple ways. We could just do it based on a risk to reward ratio. In other words, I'm going to risk 48, 0.0048. And I want to get at least 2 times that, or 3 times that, or 4 times that. So I could double that or triple that and then add that value to my entry. Now, the other way we can do it is we could use some technical analysis. We could say, we could look at our chart and say, well, where do we anticipate that we're going to run into resistance, right? Old support, new resistance. Maybe we could use Bollinger Bands. Maybe we could use, a period of time. There's a lot of different ways we can do it. So let me show you how I found the 0.023 in a second. Okay. So what is my risk reward ratio? In this case, it's 2.42 or greater than 2 to 1. I think that is definitely something we want to set trades up for. My personal preference is 3 to 1. And then I'm going to put in my quantity of shares, my position size, and that was 8,300. And so you can see that I'm risking $39.84 below our $40 allocation of 2% of our capital. And I have a potential of making $96.28. So then I can just click the applied button. And then once I get to the applied button, I just click on the chart and boom, this little box will show up and it shows us exactly where our stop would be, where our entry would be, and where our target would be. And again, looking at that potential target, Why did I pick that price value versus, let's say, a risk to reward ratio? Well, I initially set it up to 3-to-1 and it came in way above here. And so to me, I feel this is an area of resistance. And typically what I like to do is I like to set up my target just in front of or just below where I'm anticipating potential resistance. So that's why I moved that target down. I started out at 3-to-1, but it ended up to a 2.4, which is still decent in the world of trading penny stocks. Again, we're not necessarily going to exit the trade at this value. It's just something how we can manage and use this tool to decide, is this trade worth it for us? Am I taking too much risk for not enough reward? Okay. All right, so let's go to one of our Stairmasters. And again, I'm kind of looking at this one, right? Again, look at how we have 3 rocket ship rallies based on volume. And, again, ideally, maybe this probably would have been the better entry. Here's a Mariposa that the wick went through it. So again, maybe not a good entry here. We need to wait for the market to prove itself. In other words, get above this peaking or apex of our rocket ship rally, which would have been on this candle, which was another Mariposa. But again, right, the importance of risk management of using the lower value of our Mariposa as our stop. So we could have gone a 50% entry, but again, we would have just barely stayed inside from getting stopped out. So let's look at this from, let's say we have no position and we're going to use this candle. Again, that Mariposa. So let's go back and look at our 50% line. And again, I'm just going to use this to find out where that 50% is. And it looks like it comes in just under, right around 160, 190. Let's make it 162. All right, I probably could do a better job of drawing that line. All right. So I'm going to come back in here. I'm going to pull up my risk to reward. All right, my entry is 162. All right, what's my stop loss? Come to my more data, technical analysis. And I can see my 9-day is 0.248. Let's make this easy for ourselves. So that is 0.25 or 25 cents. So 162 minus 2 times our ATR, 25 times 2 is 50 cents. 1.12. All right, what is my target? All right, well, I could look at my chart and I could look for potential resistance, but let's use this from a purely risk reward basis. Okay, so I'm risking 50 cents. And I said that I think we should strive to get 3-to-1. So if I'm risking 50 cents, I want to make $1.50. $1.50 added to my entry would be $3.12. All right. So do I have a 3-to-1 risk ratio? Yeah, I do. Am I going to buy 8,300 shares? Probably not. How many shares am I going to buy? All right, let's change our parameters from our small account. Let's say we have a $10,000 account and I'm using that 2% rule. Well, what's 2% of 10,000? What's $200 divided by my risk, 50 cents. So I could take 400 share position. 400 share position is $200 worth of risk with the potential of $600 reward. But do I stop there? No. What is my nominal value? What is my position value? Again, $400 times my entry price, 1.62. That is $650. $48. That is 6.4% or 6.5% of my capital. And if I have a $10,000 account and I want to cap that at 5%, that would be $500. So again, all I have to do is say $500 divided by my entry price, 162. That gives me 308 or 300 shares. Again, I can apply that. Notice I have my little cursor here. I can put that box anywhere I want. And again, there I can see where my risk is, where my entry is, and where is my potential target. Again, at this point, after I set this 3-to-1, I'm going to look at the chart. I'm going to see where that target lines up with my chart. And it's kind of nice that it falls right in an area where I would believe that we're going to run into some resistance. Now, what I might do in this case is I might lower this just a little bit, not much, just a little. Maybe I'll get 2.8, maybe I get 2.9. But it is nice to know in relevance where a 3-to-1 ratio is, right? Because I want to try to get as most reward as possible. All right. Okay. All right, let's talk about strategies and pyramids. Now, there are many types of strategies that we can use, but what I wanted to do was just use our risk to reward ratio as a potential strategy. In other words, an exit strategy. Or how do I can pyramid, for instance, either to scale in or to scale out. Now, what are the benefits of scaling in and scaling out? Well, first of all, the benefits of scaling in, it does mitigate some of our risk. In other words, what I could do is I could find an entry level. For instance, let's say the example we just did was at 162. Maybe I don't buy all 300 shares at 162. Maybe I only buy 100 shares. And then I look to buy another 100 shares inside of that range between that initial entry and my potential risk. Or, as I showed you before, in the example with the CYBL, maybe I wait for a confirmational entry. In other words, I wait for price to come into my level and then get outside of it, right? In other words, I might end up paying a little bit higher, but greater confirmation mitigates some of the price risk, maybe not the dollar risk, but certainly the probability of price is going to go in my favor. Now, locking in profits, reducing risk, and flexibility of scaling out are the benefits. So, for instance, as price rewards me, as price gets to those greater risk reward levels, then I could use strategies to help me lock in profits. I can use strategies where I could take some profits that help reduce the risk of the initial trade. And what I'm going to show you in a second is some variations and ways that I can flex a position. So here's the basic rule is once the market starts to reward you, you are in a position of strength. And once you get in a position of strength, it's a lot easier for us to create that potential lottery ticket. All right, so here's the breakdown on this. Again, we're going to use our risk reward as a strategy. And there are 3 strategies that we can employ based on the risk reward ratios. So the first one, 1-to-1, is very conservative. Now, I know a lot of newbies or first-time traders like this one because this allows them to quickly take profits or take money off the table and to help them to recapture some of their risk. So in this one, what we're going to do, but it is limited in potential, by the way. So you're going to take in half the original risk. First of all, when price gets to 1-to-1, right? We're going to sell half the position and leave our stop at the current level, that original stop level. So what does that do? Well, it takes in half the original risk, but it reduces our position in half. So if price reverses and stops us out at that original risk level, then we're going to break even. We're not going to lose any money on the trade. That's why this is very popular for beginner traders. The next one is where we're going to look at the 2-to-1 risk reward ratio. Now, 2-to-1 risk reward ratio is a little bit better. And again, if price gets to 2-to-1 risk reward, then I'm going to sell half my position. And I'm going to move my stop to my entry level. Now, what does this do? Well, it helps me recoup that original risk, and the position that's left, I will exit at my entry value. So again, if you think about this, I've recaptured my original risk, and if I do get stopped out, I've really added one more chance to my capital account. Now, again, my preference is the 3-to-1. And why? Because now we really have a lot of flexibility in ways that we can change the variations. But let's walk through the 3-to-1. So if I get to 3-to-1 in terms of a risk reward, price moves to rewards me 3-to-1, right? I'm going to sell a third of my position, and I'm going to move my stop to my entry price. Again, in the worst case scenario, I get stopped out, I'm going to recoup that original risk. But the benefit here is that I'm going to maintain a much larger majority of my original position. So there are some variations and some flexibility to this. So let's think about that. So if I get to 3-to-1, now what I could do is, let's say I might move my stop and I might refrain from selling. Or I might sell increasingly smaller portions of my position. In other words, I could sell a third, and then when I get to 4-to-1, maybe only sell 25. Excuse me, if I had, let's say, a 300 share position, I might sell 100 shares at 3-to-1. Then at 4-to-1, I might sell 25 shares or 50 shares, and at 5-to-1, maybe I'll sell 25 shares. And so at each occurring greater risk reward level, I might reduce the amount of my position selling, or maybe not selling at all. The other variation is every time I achieve another level of risk reward, again, I get to 4-to-1, then what I could do is I could move my stop position to, let's say, 2-to-1. Now, again, our goal here is, we want to scale out, pay for original risk, lock in profits, but keep in mind that our real long-term goal is that we want to maintain a position. But if I get to 3-to-1, I sell a third of my position, and I move my stop to 1-to-1, well, it achieves all of those, right? It pays for my risk, it locks in profit, and then at that point, I don't have to do anything, right? If the stock goes up, happy me. The stock comes down and stops me out at 1-to-1. Okay, I put a little bit of money in the bank. Okay. All right, let's do this. I want to go to our investment page, but I do see a couple questions here, Gene. So let me pause for a moment before we get to the top of the hour. Let's see if I can answer, or if I haven't already answered them. So there's a question about how to read bid and ask. I just want to show over-the-counter stocks are delayed, but if you go to any stock, for instance, you can see up here, you will see the bid and ask. And again, this might be a low volume stock, and you can see the bid is 412 and the ask is 420. 8 cents is pretty wide for, a $4 stock. And you can see how many shares are on the bid and the ask. Okay. Yeah, again, I'm not talking, there's a question here about commissions and fees. Yeah, some of your brokers will charge you depending on your platform. Um, but there's a lot of platforms now that charge you a very minimum, or actually will let you trade a lot of these penny stocks for low commissions or no commissions as long as you maintain a certain monetary level in your account. Okay. All right. So let's go back to our investing page. And under investing page, we have hot penny stocks. And here's where we are screening the penny stock market, and we're looking at stocks that have a high 5-day percentage change where the 5-day average volume is greater than the 20-day average volume. So this is what I would do. I would use this page to start as you're jumping off to look for potential candidates. And I would go into our views here, our default views, and look under performance. And I'm going to use the weighted alpha. Now, weighted alpha is how much the stock has moved over a year with a higher weighting towards recent price action. Now, penny stocks typically, when they start to move, you have a large percentage price movement in a very short period of time. So weighted alpha could be a little bit distorted, but if we have a big price movement in a very short period of time, then you should have a positive weighted alpha. So what we're going to do here is we're going to look at those stocks. Again, there could be some candidates in here, but again, I'm just going to give you a jumping off point. Looking at those that have positive alpha, but then I'm going to look to see which of those have a positive alpha and a nice performance over a 1 month period. Or I can cross-reference those with the ones that have a performance over 5 days or a combination of the two. So look at the 5 days here. I'm just looking at a couple of names here. And then let's look at this again from the weighted alpha aspect. And you can see there are a couple of names that repeat here. Okay, so what we're going to do now is to do that pattern recognition, right? We're going to go to our flip charts. We're going to look at our chart, right? Here's our nice rocket ship rally on volume. So is this a trade? Yeah, this could be a potential market for me. But, what am I going to do with this Mariposa, right? I'm going to look for an entry at 50%, or I'm going to set up a risk below it. Maybe I need a few more days to design this trade, right? Or I could use my, my average weighted volume price. Again, probably going to need a couple days before I can get to that. All right. This one has been on the hot stock for a while. Again, impulse correction, right? Now we got another impulse. Again, what could I do? Well, I could probably come back and look at my VWAP, and let's go from, our launching pad. And so, somewhere from our traditional 20-day moving average to our VWAP, here is support. So maybe I would be looking for an entry somewheres in here. And then here is EOSE. Now, full disclosure, I mentioned this in the last session. This is one stock that I currently own. It's in my portfolio. And this red line here represents approximately where I got in. I got in on this candle here, but I think my entry price was 205. But let's look at this in terms of a trade. So, I have a big volume day on a breakout of a range, and those are the kind of trades I like. 205 entry. What is my risk? Right. Again, 24. This one has been pretty consistent. So 2 times 24 is 48. Let's just round it up and say 50 cents. So 205 was my entry, minus 50 cents would be 155. You can see that puts me right in this, near this swing low, which that gives me a lot of confidence that that is a good risk amount. Now, what would I set up my reward? Well, if I'm risking 50 cents, so I want to make at least 3 times that, or $1.50. So I add $1.50 to my 205. That puts me at $3.55, which you can see we are currently or just recently gotten to. So what am I going to do now? Okay, so I reached my first objective. So what I could do, I could sell a third of my position and move my stop to 1-to-1. So here is $2.50 or 50 cents above my entry. That would be the 1-to-1, and I would have sold out a third of my position. But remember we said when the market starts rewarding you, we have a lot of flexibility and variation. So maybe instead of selling out, because this stock does look nice, right? You must agree it does look good, a nice performing market. Maybe I don't sell out my whole position or my allocated position or my strategy position. Maybe what I'm going to do is I'm going to manage this from a risk side. In other words, what is the highest price that this got to? And I'm going to, or look at current price and say, well, what is my risk? What's my volatility risk? And my volatility risk is my 2 ATR. And in this case, our 2 ATR was 50 cents. So instead of selling out 100, let's say it's a 300 lot position, instead of selling out 100 shares, what I'm going to do is I'm going to move a stop to where if price moves 2 ATRs directly against me, I'm going to exit that 100 shares. Now remember, we still have the majority of our position. We move to 1-to-1, a position of profit. But let's say the market rewards me again and goes to, let's say, $4. All right. Now, what am I going to do there? Well, what I can do now is I can do something called leapfrog. And so this was our 1-to-1. Remember, we said that we could move this to 2-to-1. We can maybe move as we get greater risk rewards. But what I'm going to do here is I'm going to leapfrog this into a variable of my volatility. In other words, let's say we got up to $4. What is my ATR risk? 50 cents. So I'm going to leapfrog this position to $3.50. And then if the market goes higher, let's say it goes up to, let's say, 4.25, right? Then I'm going to move this from 2-to-1 to that risk variable, 375, let's say. And so what I can do is I continually leapfrogging my stops that I have now broken up into different positions, allocations, which continues to lock in price, but I'm not exiting the market, am I? I'm maintaining that much larger position. Okay. All right, let's do this, Gene. All right, a couple of takeaways and then we'll finish up. First of all, just remember that trading and investing is about having rule-based plan, right? And I think we worked on a lot of trade ideas, trade plans, and rules, right? And remember, our goal as a trader and investor is to look for low risk, high probability, high reward trades. Discipline and consistency, that is the key to success of all trading. Now, because penny stocks are unique in their price movements and their volatilities, we can quickly recoup our units of risk. We can lock in profits. And, if I take in my unit of risk and I lock in my profit, then I really don't care what that stock does, right? If the market goes against me and stops me out, so be it. But I have no emotion to that stock, right? I can just let that stock run. Our ATR, great tool for measuring volatility, but also a very practical way to managing our risk. Again, I use a 2 ATR. You might use a 3 ATR. Some long-term investors use 5 ATRs. Again, it depends on your risk tolerance. But you will agree with me once you start using this that it is the Swiss Army knife of technical analysis, and that professional traders do use it to help define not only the unit of risk, their stops, and their position sizings. Remember that we're in a long game here, right? We want to find many chances, right? We don't want to get blown out. That's what we're trying to eliminate, right? So your results are going to improve with time and discipline and not gambling and luck, right? I guarantee you the time you move outside your rules, that's when the market punishes you. Track your performance, right? Keep a logbook. See how you can maximize or optimize your trading strategy. Find which of those trading strategies, those risk reward trading strategies that work for you. I really like when I get into a position of strength. Once I've recaptured my my original risk and locked in profits of leaving my position on, letting that position run, and just continuing to move those stops, leaping, frogging those stops. Now think about this. Imagine if I had a $100,000 account and I'm using a 2% rule, $2,000. But I'm not using that 2% rule per trade. I'm using that percent rule as a per day. And now I have a $2,000 where I can spend per day trading penny stocks. And I go to our hot stocks and I do that risk, that alpha assessment. And now I have 10 potential candidates. Let's say I only find 4 that I like. I set up 4 trades where I'm only risking $40 worth of risk, or 5 trades where I'm risking $40 worth of risk. That's only what? $200, right? $200 a day in risk. But what if I do that every day for a month? 5 trades for a month, that's 100 trades, right? $200 worth of risk, $2,000, right? $2,000 of risk in my total capital. But now I have 100 penny stock trades on. What do you think the probability is that I'm going to catch one of those great winners? Keep that in mind on how discipline and leverage can be to your advantages. Okay. Next week, I forget, Gene. Oh yeah, we're going to talk about momentum and bullish stock screeners. We have a couple of them. We have bullish moving averages, and I think there's another one in here. I just lost my train of thought for a second. But we're going to look at those screeners and look at ways to look at potential candidates, and again, use a little risk management to help us find potential winners. If I didn't get to your questions, send them to support@barchart.com. If they can't answer it, they'll pass them along to me. So until next time, folks, thanks for joining us. I hope you had a good session today. If you're watching us on YouTube, give us a thumbs up. Until next time, best of health, the good of all trading.